With FTX filing for Chapter 11 bankruptcy, regulation is back in the forefront for the crypto industry as a lot of creditors wait and see if their funds are restored and other investors search for a safe way to hold digital assets. Well, joining us now is Jeff Horowitz, BitGo Chief Compliance Officer and former Coinbase Chief Compliance Officer. Good to have you on the show. So as SBF has stepped down from FTX, John J. Ray III, who was actually worked on bankruptcies for Enron, not a great name to be associated with in this case. But as we're sort of seeing all of this play out, a lot of people wondering, in terms of regulations, there are existing regulations. Why didn't they do enough to stop this?
Oh, great question. Look, the bankruptcy highlights a lot of the market structure issues, including the lack of regulatory clarity or a workable regulatory framework here in the U.S. And it's driven many of the exchanges overseas rather than the U.S., where we have great consumer protection and bankruptcy protections, right? The guidance we've had in the U.S. has pretty much come from enforcement actions, investigations, which is a little too late. Here in the U.S., we have trust companies, we have banks, we have broker dealers, right, who are required to fully segregate customer assets, not commingle customer funds, provide audited financial statements, and have AML and fraud monitoring obligations. We have both FDIC and SIPC coverage. And so I think the best solution is to put those exchanges, require them to hold with an independent qualified custodian those assets so that you can take away some of those fraud potentials and the potential for bankruptcy that we just went through with FTX this week.
Jeff, I want to take a step back here. I worked with the SEC many years and careers ago, so I understand the process. And what struck me about the rise of DeFi and crypto over the last couple of years, specifically with respect, a lot of companies in the U.S. wanted to be able to pay their customers interest, as is done internationally. But the SEC squashed that, and a lot of these companies tried to work with the SEC. Some of them got subpoenas for their efforts. Your former company, Coinbase. I'm not going to ask you to comment on that in particular, but do you think that there's been a comeuppance that crypto industry is hiring the right people to understand the seriousness with which the regulators themselves attack and see this market?
I think we have a bunch of adults in the room trying to figure out the best way forward. We've had ongoing conversations with both legislators and the regulators to figure out a sensible path forward. Coinbase was restricted from offering their yield product, but that's not some of the same yield products that others like Celsius and Voyager, had material issues with. I think the regulators have not figured out a sensible path. And I don't think we need to call everything a security or, every token and coin a security to figure out how do we get proper risk disclaimers and disclosures so that consumers can be fully protected or understand what their risks are. I'm not sure what it's going to take. How many more bankruptcies do we need to have before we can get this right?
Good to see you, Jeff. Yeah, interesting that Maxine Waters, who's the House Financial Services Chair, and her likely successor, Patrick McHenry, have both made statements about further regulation coming. But it's kind of ironic, isn't it? SBF was the one calling for regulation on Capitol Hill. If some of those things that, again, ironically, he was calling for were put in place, would it have stopped this?
Look, it's hard to stop a fraud. It is able to put some guardrails up that trust companies or banks who have formal obligations to segregate those customer assets and would be audited, those frauds would be found a lot earlier. So it's very hard to stop someone from doing something fraudulently, which appears to be the case with SBF. As an industry, we are looking forward to regulation. We think the more clarity we have can bring some of that innovation back into the U.S. and make the crypto ecosystem safer for all that want to participate.
And Jeff, in terms of global regulation and the role that plays, when you have companies obviously have U.S. holdings, perhaps potentially allegedly commingling then with their international arms, how close are we to getting some form of global regulation on this, and how important is that?
Well, I think it's important to have global regulation. Otherwise, we're playing a game of go to the path of least resistance around the globe. Right here in the U.S., we have the strongest consumer protection laws. That's a good place to start. I've been working with the FATA for over 4.5 years on some of the fundamental global AML and KYC standards. We still don't have that around the U.S., and we definitely don't have the right requirements of how do you hold customer assets, how do you ensure that they're not commingled. The blockchain gives us great transparency where those proof of reserves can be validated but we just haven't gotten there yet. And I think the best way forward is to require exchanges to keep their funds with an independent, qualified, and regulated custodian. Not everybody who claims they're a custodian is actually regulated. Our firm is a trust company in South Dakota and in New York, and we are audited and reviewed by some of the strongest regulators, here in this U.S. country.
Jeff, I'm wondering if that's enough. If I look at the history of exchanges, how they evolved over hundreds, if not thousands of years, the most popular model probably has a risk-sharing mechanism where the members of an exchange share counterparty risk in total for whatever goes on. One or more of them may fail, but the system as a whole is designed to be able to withstand a lot of those shocks. And it's worked. Is there a crypto equivalent? Because it seems most of the exchanges are just broker-dealers that also happen to be exchanges for one proprietary token or security.
Yeah, well, like a great example here in the U.S., the New York Stock Exchange and the NASDAQ, they're exchanges, but they're not also custodians, right? That's outsourced to clearing broker-dealers and ultimately to DTCC. Here we have commingled between exchanges that operate both as a trading arm, a clearing arm, as an exchange trading arm. That's probably not the best model long-term. So I think we need to figure out what is the right separation of duties to make it safer.
I just want to quickly ask you, obviously, when you have a big personality like an SBF, and he's only 30 years old, but we saw so much reliance, not just by retail investors, but institutional investors as well. Talk about the cult of personality and the role that you think this has played in some of these big players in the crypto industry.
Hey, back in the day, everybody trusted Bernie Madoff, right? He was one of the pillars of the NASDAQ and the society, and you put trust in that. But sometimes you have to trust but verify and actually do better due diligence. I've met with regulators in Washington for the last 4 years, and we're trying to find a path forward. And there are some good actors in the space, but sometimes they're bad actors, and it's hard to find out who are the good actors when they're putting on a good show. I'm not sure when this fraud started. I'm not sure if it started during the Three Arrows failure and SBF stepping in to try and plug some holes in Alameda Research's books. But I think he had good intentions and maybe have gone off the rails somewhere.
All right, Jeff Horowitz, great stuff. Really appreciate you being with us here.